to be a fair number of people have now been able to join. And so if we can begin the webinar, obviously, which is the topic of buy to let landlords, where are we now, and in particular following the budget that we had in March. Sam, if we can move on to our first slide, please. So for those of you who don't know me, I'm Alistair Wilson. I'm one of the partners here at MHA Tait Walker. I'm joined today by Dorothy Johnson, who is a manager within our private client team, but who works extensively with our buy-to-let landlords or with individuals who have got residential property as investments across the region. If we can move on just to the next slide, Sam. Thank you. So in terms of this presentation today, we will have a question and answer session at the end of the webinar, but in reality, we have got what's effectively a question and answer button at the top of the screen. So if you're looking at your screen on Teams at the moment, there is, in one of the icons at the top, there's one that looks like it's got a question mark in it. If you use that, if you do have questions, you can post them as you go along, and by posting them as you go along, we will be able to try and answer them as we go through this webinar. At the end, if there are questions that are of general application to a large number of people, then we'll recap on them just so that you're able to see what the question and what the answer was. We will be sending a copy of these slides to all of the attendees. We will also be sending a recording of the webinar to the attendees as well. If we can move on to the next slide, Sam. And just in terms of the speakers today, it's myself and Dorothy. And this is the ideal time for me to hand over to Dorothy, who will run through with you on the first major part of this presentation.
Morning, everybody. Thank you very much, Alistair. As Alistair said, I'm Dorothy Johnston. I'm a manager in the private client team based in our Gosforth office most of the time, although not quite so much at the moment. And I'm going to talk to you about some recent changes for buy-to-let landlords and offer some suggestions if you've been badly affected by the changes, suggestions of what you might do to make things a bit better. And I'm also going to look at a change that's coming up on the horizon. Next slide, please, Sam. So from April 2016, there have been a few changes that have affected buy-to-let landlords. First of all, we had the rate of stamp duty land tax on buy-to-let residential property, or indeed second homes, increased by 3% for each band. So that obviously makes it quite a lot more expensive for you if you're going to be thinking of building up your portfolio, because you're going to have extra costs of acquisition. Then we had the abolition of wear and tear allowance. That was something that was available only to landlords of furnished properties, but it was very generous because regardless of the amount that you spent on replacing furnishings and fittings in your properties, you were allowed to deduct 10% of your net rents from your income when working out your profits, even if you hadn't spent anything like that amount. So that was very generous. That went in April 2016. The next change, and the thing that caused a lot of commotion at the time, was the removal of tax relief on loan interest at marginal rates. And all you get now is that relief is restricted to just 20% of the interest that you pay each year. Then more recently, there's been a change to reporting capital gains tax on sales of residential property. Now you've got to do that within 30 days of completion of the sale. And the change that's coming up is making tax digital for income tax. And I'll be talking a little bit about that at the end. So next slide, please, Sam. So it's actually nearly 6 years since the Chancellor announced that tax relief on loan interest was going to change, and it was going to be restricted to just 20% instead of being available at your marginal rates. And very quickly we realised that this was going to be pretty bad news for landlords with residential property. It wasn't going to affect commercial lettings, It also doesn't affect furnished holiday lets or limited companies. But for landlords with residential property, it wasn't good news, because at that point, or before the change, when you worked out your taxable profit, you deducted all of your expenses and all of your mortgage interest when working out the figure that was going to be taxed. But when the change started to come in, that wasn't the case anymore. And now, in April 2020, you don't get any deduction of loan interest from rent when calculating your profit. Next slide, please, Sam. And this slide just shows how the change was tapered in over 4 years. So starting in the first year, 17-18, you were still allowed 75% of your interest when you were working out your profit, and the remainder, you just got a 20% tax reduction. So that maybe wasn't a very big effect in the first year, but skipping forward over the years, you can see the proportion allowed as a deduction fell. And now, when you complete your 2021 tax return, that's the one for the year that's just ended in April, you might be very efficient, you might have done it now, but it's coming up, and there is no deduction at all of interest when you're working out your profits, and instead all you get is a tax reduction of 20% of the interest that you've had to pay during the year. Next slide, please, Sam. So this example just shows us a landlord with a very heavily mortgaged portfolio. His position back in 16-17 before the change happened, and his position when he submits his 2021 tax return very shortly. So we've got rental income of 180,000, interest of 110, and other expenses of 48,000, giving rental profit or net rental profit in the landlord's hand of 22,000. In 16-17, there was the personal allowance of £11,000 to take off, which left 11,000 to be taxed at 20%, which was just £2,200. So in 16-17, after paying his tax and all his other expenses, this landlord had a cash profit of 19,800. Compare that with the 2021 tax year, you'll see there's no deduction at all for interest, and that gives rental profit of £132,000. There's also no personal allowance allowed, because once your income's over 100,000, the personal allowance is tapered away, and once your income is over 125,000, you don't get any personal allowance at all. So this landlord now has taxable income of 132,000. He's got the first 37.5 at basic rate and balance at 40%. Then you can see a little further down the column, we do take off the finance costs relief, which is 20% of the 110,000, and that gives a total tax liability of £23,300. And instead of having a cash profit, he's left with a loss. And that position is just not going to be sustainable over any length of time. Next slide, please. So if you find yourself in this position, and obviously that example, there was a lot of interest. You're not going to be so badly affected if you don't have quite so much interest. But if you do find yourself badly affected, what can you do? Well, if you can, you could use savings to pay off your mortgage debt. Obviously, that would be an investment decision, and you might want to think about what other uses you would have for your savings. But if you could do that, that would reduce the effect of the changes. Or you might want to try and get a better mortgage deal. If you're currently on the standard variable rate, can you get a cheaper deal? You might want to think about giving property to your spouse or civil partner if they have a lower tax rate than you. There isn't any capital gains tax to pay on that transfer, and you might be able to take advantage of lower tax rates payable by the lower earning spouse. You would have to watch out if the properties were mortgaged, because there could be some stamp duty land tax to pay on that, but you could do some planning and maybe do the transfer in stages to minimise that. Another thing that you might have to do or might consider doing is selling properties to pay off your mortgage debt. That will obviously reduce the effect of the changes. One thing to watch out for there is that if the properties are worth more now than when you bought them, there would be a capital gain, and you would have to pay some capital gains tax, and that would reduce the funds available to reduce your mortgage borrowings. The final thing that you might think about doing is transferring your properties into a company. And you might want to do that because loan interest is still a deduction which reduces taxable profit, and also corporation tax is actually only 19% at the moment compared to personal tax rates which can be as high as 40 or even 45%. Do be aware that the corporation tax rate is due to increase to 25% in 2 years in April 2023. Next slide, please. So if we go back to the landlord that we looked at a moment or two ago and consider what his tax position would have been if, instead of being a sole landlord, he was operating as a limited company. And you can see there that the mortgage interest is still in there as a deduction from profit. Then he pays himself a small salary of just below the primary threshold, so there's no national insurance to pay, and the balance is subject to corporation tax. And after that, he pays himself a dividend to pay out all the rest of the profit that he's got. His actual tax liability, his personal tax liability, would only be £384. And when you add that onto the corporation tax the company would have to pay, he's still got a really fairly decent cash profit after he's paid his tax bill. Not quite as good as it was right in the beginning before the change to interest relief started, but not an awful lot of difference. Next slide, please, Sam. So if you find yourself in that position and you're thinking, oh, incorporation sounds like a good idea for me, you need to consider if there could be any problems. And unfortunately, yes, there could be. There could be capital gains tax and stamp duty land tax. And I've got separate slides on them in a moment. You will also find that you would have to refinance your loans. And the problem is that I think the choice available for limited companies is not as wide as it is for individuals. And also you might find that the rate of interest offered is higher in a limited company than it would be to you as an individual. So you would have to factor in that cost in your decision. And you might actually pay more tax overall. Next slide, please, Sam. So why would you have to pay capital gains tax? That's because the transfer of properties into a limited company is treated as a disposal at market value. So if the properties are worth more now than they were when you bought them, there's a capital gain. And if you've got a big portfolio or there's a big gain on the property, that's going to be costly. Now, in certain circumstances, you might be able to claim incorporation relief. If you can demonstrate that you're running a property business and you transfer all of the assets, apart from cash, into the company in return for shares, what happens is that the capital gain is rolled over into the base cost of the shares. So that means there's no capital gains tax to pay on the point of incorporation. That sounds quite good, but unfortunately, the problem is that you have to be able to prove to HMRC that you are actually running a property letting business. And if you've just got 1 or 2 properties and you don't spend an awful lot of time managing them, or if your properties are managed by an agent, that's not going to qualify as a property letting business. Really, you need to be able to show that you're spending a substantial amount of time each week working on your property business, and it should really be at least 20 hours a week. In the past, you used to be able to apply to HMRC for non-statutory clearance that the transaction that you were proposing would qualify for incorporation relief. And a lot of, we did this for quite a lot of clients, and I think a lot of people did it, and the revenue obviously got sick of this and they've stopped giving clearance. So if you want to incorporate your property letting business, you're going to have to do probably about the same amount of groundwork that you would have had to do if you were going to apply for clearance. And you're going to have all that evidence ready to show just in case you get an inquiry from HMRC. And it's one of the things that we found key is it's the amount of time that you spend working in the business, and it's a really good idea to keep a careful record, perhaps a sample diary for a month or 2, so that you can prove that you really do spend a lot of time working on your business. Next slide, please. The other issue that you may well have is stamp duty land tax, because that can apply to the transfer of property to a limited company, and the rates can be as high as 15%. If you're buying 6 or more properties, you might be able to use commercial rates, which are lower than residential rates, or you might be able to claim multiple dwellings relief, and that would reduce the rate of stamp duty land tax, but the minimum rate is always going to be at least 3%. However, if your properties are held in a partnership or limited liability partnership, it can be possible to claim a relief so that there wouldn't be any stamp duty land tax to pay on the transfer, as long as the shareholdings in the new company mirror your interests in the partnership or the LLP. Again, you need to be able to demonstrate that you are indeed operating a business, and you really need to be able to show that you are operating as a partnership as well. So as much that you can have in place to show that, the better. Have you got a partnership agreement? Do you prepare proper accounts for your partnership? Are you maybe even doing a partnership tax return? All of those things would count in your favour as evidence that you are a partnership. But if you can do that, then you might be able to incorporate your portfolio without paying any stamp duty. Next slide, please, Sam. So my next slides, I've got 6 slides in all, and they come in pairs of just comparing net rental profit and the tax position of a company with what the tax position would have been if you were working as a sole trader. So this first slide, we've got net rental profit of 50,000, but there's loan interest of 20,000, so rental income is actually 70,000. And you can see from this that if you extract all of your profits from the company, you'd be a little bit better off as a company than you would have been as a landlord, just under £1,700. And that would be the same in 2 years' time when the rate of corporation tax goes up. And that's because with profits of just £50,000, you're still going to be paying 19% corporation tax rather than the higher rate of 25% or the marginal rates, which are even higher. On the other hand, if you don't need all the profits and you just take 25,000 out of the company, then you can see the saving is bigger. And that's because when you're taxed as a landlord on your own, you have to pay tax on all of the profit. But when you're operating as a company, you pay tax on the company's profit, corporation tax, and then you only pay income tax on the money that you actually extract from the company. Next slide, please, Sam. So this is the same example, but this case there's no loan interest. And you can see actually in this situation, if you were a company as opposed to a sole landlord, you'd actually be worse off, which just wouldn't be very good. Next slide, please. So this one, we've got net rental profit of 100,000, and again, loan interest of 20,000. You can see that in the current year, 21-22, you'd be nearly £5,000 better off as a company. That part of that saving is reduced when we get to 23-24 because the corporation tax rate is higher, and you can see that £2,000 has been taken off your sort of better position. But it's still a decent saving, and the saving's much more if you don't take all of your profit out of the company. If you just take 50 instead of extracting the whole lot. Although you can see that the saving goes down when the rate of corporation tax goes up. Next slide, please, Sam. Again, the same amount of rental profit, 100,000, but with no interest. In this example, if you extract all the profits from the company, you're actually going to be worse off in the company than you would have been as a sole trader. But if you only extract £50,000 of the profits, again, you are better off. Although you can see the benefit is reduced when the corporation tax rate goes up. Next slide, please. Another example with a higher profit, we've got profits of 260,000, but again, 20,000 loan interest. If you extract all the profits from the company, you still will be worse off in a company than you would have been as a landlord in the current year, and a lot worse off in 2023-24 when the rates go up. But on the other hand, if you just extract 100,000 or even just 50,000, you'll be significantly better off as a company than you would have been as a sole trader landlord. Next slide, please. So same situation, no loan interest. Again, better off if you're not taking all of the profits out of the company, but worse off in a company if you're taking all the profit out. Next slide, please, Sam. So what I've hoped to have demonstrated over the last few slides is that there isn't a one-size-fits-all situation, or one-size-fits-all solution, sorry. And whether or not incorporation will be a good idea for your property portfolio will depend on a lot of factors. It'll depend on the amount of income that you have. It'll depend on the amount of mortgage interest that you have. It'll depend on the amount of money that you need to take from the business. You do need to be aware that there are increased costs of using a company, and that could use up some or all of the savings. So actually, if you're only a little bit better off as a company compared to as a sole trader, you might find that by the time you've factored in your accountancy fees for having to do limited company accounts and a corporation tax return, that most of your saving has disappeared. But if the idea is to keep the rental profit in the company and use it to reduce your borrowings or build up deposits to pay for new properties to add to your portfolio, then a company really can be beneficial. And I think that's the last slide in this section. So I'm going to hand you back over to Alistair.
Thanks, Dorothy. And just to give you a few minutes breather whilst I go through the stamp duty aspects. One of the key things in the budget and one of the key measures that has helped sustain the housing market over the last 12 months has, of course, been a reduction in stamp duty for many purchases. And so I'm just going to quickly cover that because there are changes coming. And now many of you will be aware of the impending deadlines, but I thought it's worth just covering them quickly. So Sam, if we can move on to the next slide. Now this slide effectively talks about the position for somebody who is buying their main residence. It's really just to illustrate the reduced stamp duty and the phasing in terms of the reduced stamp duty, and that it's phasing back where the exemption for main residences, it's reducing at the end of June and then effectively being phased out at the end of September. If we move on to the next slide, Sam. Now, really where this becomes more important whenever it comes to buy-to-let properties, clearly the point is around those being classed as either second homes or additional properties. Now, one of the things, first of all, to be aware of on this, we've deliberately classified this slide England and Northern Ireland. The rules in Wales are slightly different, but there is a reduction, a phased reduction happening in Wales as well. Second properties in Scotland, their reduced rates of stamp duty ended at the end of April. The end of March. They didn't extend the reduced stamp duty that they have there, land and buildings transaction taxes. So this now is something where there is a difference. There is a saving if you were to buy properties in England and Northern Ireland, as opposed to, for example, buying them in Scotland. Now, these are temporary changes. It is definitely driving the market. It is definitely something that is encouraging people either to accelerate purchases of main residences or to use potentially some of the money that they may well have built up through the lockdown periods to look at buying either buy-to-let properties or buying holiday homes, and I suppose the support for the prices in the marketplace at the moment. One of the questions might be, will you end up paying more to buy a property now in terms of its headline price than you would save in terms of stamp duty if you were to wait until, for example, October? One of the other questions is in terms of the conveyancing process, can you actually get the conveyancing process completed either before the 30th of June or before the 30th of September? But In terms of additional properties, there is a stamp duty saving if you manage to get an additional property transacted before the end of September. Now, one thing that we are seeing people doing in terms of their own property portfolios, one of the points that Dorothy has mentioned in the past about incorporation, stamp duty is something that can be a cost in an incorporation process. Stamp duty can be a cost whenever you are simply transferring a single property from personal ownership into a investment company. So one thing just to be aware of, if you are transacting properties within your own ownership, then actually the stamp duty reduction may well give you an opportunity to do that now with a lower cost than you will face if you do it after the end of September. So in terms of stamp duty, just think about the fact that there is still a reduction in the stamp duty for transactions completed before the end of September. And at this point, I'm going to hand back to Dorothy.
Okay, thank you, Alistair. So the next section that I'm going to talk about is the reasonably new requirement to report gains on residential property within 30 days of the transaction happening. Next slide, please, Sam. So from April last year, if you dispose of a property, and that means selling it or giving it away, and there's a capital gain, then you've got to report that to HMRC and pay the tax within 30 days of completion. So there has to be a gain on the transaction. So that means that you don't have to do it if there's a loss on the disposal, or if there is a small gain, but it's covered by the annual exemption or principal private residence relief. You also don't have to do it if the transaction is covered by the no gain, no loss provisions, and that would be typically where it's a transfer between spouses or civil partners. Next slide, please. When you are looking at this, you've got to work out the capital gains tax that's going to be notionally payable at the filing date. If you don't have all the information available to you, you can make reasonable estimates, but you would then have to go back and correct that later on. You ignore non-residential gains in the same year prior to the transaction. You do take account of earlier residential property disposals. So if you've already sold one property, then you're going to have to take that into account when you do your second report. You can take account of the annual exemption, but obviously only once. You can also take account of losses that have been brought forward from earlier years. And you can also take account of lossing arises on any assets in the tax year that you're dealing with up to the date of completion of the transaction that you're dealing with at the moment. Next slide, please. Then you have to decide what rate of tax is going to be applicable to the gain. So the question is, how do you know what rate to use? Well, the rate of capital gains tax is dependent on your income and the rate of income tax that you pay. If the gain, the capital gain, is such that the gain plus your total income is less than a basic rate band, then you'll only pay 18% tax on the capital gain. However, if you're a higher rate taxpayer, then you'll have to pay 28% capital gains tax on the gain. And if the gain takes you from basic rate into higher rate, then part of the gain is taxed at 18% and part of the gain will be taxed at 28%. Next slide, please. So if we look at an example of how that's going to work, we've got John, Paul and George, and they sell a rental property and they make a gain of £90,000. They've got a £30,000 gain each. Earlier that year, George had already sold a residential property for a gain of £20,000. Their income levels are: John has an income of £20,000, Paul has £40,000 and George has £60,000. If we look at the next slide, please, Sam, we'll see the tax that each of them has to pay. So along the top line, all three of them have a capital gain of £30,000. John and Paul can deduct the annual exemption, which is £12,300, but George has already used his up on his previous disposal. So the taxable gain for John and Paul is £17,700, but George has got a taxable gain of £30,000. Then we apply the tax to this. If you remember from the previous slide, John's income is £20,000. So when we add on the taxable gain, he's still within the basic rate tax band. So he only pays capital gains tax of 18%, and that's going to give him a bill of £3,186. Paul, on the other hand, had got income of £40,000. When we add on his taxable gain, that's actually going to straddle the basic rate and high rate tax bands. So he's going to pay some of his tax at 18% and some of his tax at 28% on the gain, and he'll have a bill of £3,928. George, he had income of £60,000, so that makes him a high rate taxpayer. So he'll have to pay tax on all of his capital gain at 28%. So he has a bill of £8,400. So you can see there's a big difference in the tax payable for the same amount of gain, and that's because of the income that the three people had. Next slide, please. Now, I think I mentioned before that you can take account of losses. So let's imagine that George had a share portfolio and he'd already sold some shares that year, creating a loss of £20,000 before the property transaction happened. In that case, George would be able to set that loss of £20,000 off against his capital gain of £30,000. So his taxable gain would actually only be £10,000, and the tax on that at 28% would be £2,800. On the other hand, if he didn't sell the shares until after the sale of the property, he couldn't factor that in, and he would have to wait until he actually submitted his tax return before he could make an adjustment to the tax payable. Next slide, please. So having looked at how you work the tax out, the next question is, how do you make a report? You've got to do it within 30 days of completion of the transaction, not exchange of contracts. You must do it online via your digital tax account by creating a capital gains tax on UK property account. Your agent or your accountant can submit the return for you, but they will still need to know what your capital gains tax on UK property account number is. So you will have to set up a digital tax account, unless in very specific circumstances you're a digitally excluded person. In that case, you can use a paper route, but the same time limit applies, and 30 days to apply to HMRC to get a paper form, for them to post it to you, fill it in and all that kind of stuff. You're really going to struggle to meet the deadline. If you've got several disposals with the same date, you can put them all on just one return to save you doing lots of returns. But if you've got several disposals with different completion dates, you will have to do separate returns for all of them. Next slide, please. So the next question is, once you've sorted that out, what do you actually have to put on the report? And the answer is a lot. You've got to put all your personal information. You've got to put full details about the property, its acquisition and cost, and dates of acquisition, dates of disposal, how much you've sold it for, or the market value when you dispose of it. You also have to state any reliefs that you want to claim. So was it your own house for part of the period of ownership? Can you claim private residence relief? Are there any losses prior to the disposal that you want to deduct? Are you claiming relief from brought forward losses from earlier years? And how much of the annual exemption do you actually want to deduct from this transaction? Next slide, please. And it goes on. Then you have to put into the report an estimate of your income in the current year. And you also have to say how much personal allowance you think you'll be entitled to. And you have to say, are any of the details in the return estimated? Then you have to put down how much tax you think you owe. And finally, you need to upload a calculation of the gain with the report. After you've done that, you will be provided with a payment reference number, and you'll have to use that when paying your tax. And you've got to pay the tax as well as doing the report within 30 days of completion. And there are penalties for late payment. So that's quite a lot to do. And we're finding that people are coming to us saying, oh, sold a property, sold it last year. And we say, well, did you do a capital gains tax report? And you know, the blank expression says it all. We're finding that people aren't being told about this necessarily by the solicitor who's dealing with the transaction. So it is something that you need to be aware of, because you do have to do a report if there's a gain within 30 days. Next slide, please. If you're in self-assessment, you will also have to report the gain again on your tax return, because you've got to put details of all of your income and all of your gains onto the tax return. So you're going to have to report it twice, basically. Although, of course, you should have all the details available from the original report that you did. But at this point, if you find that now you've got the answer to estimated figures, have you got the right figure now? Or obviously you'll have your right income details, then you'll be able to make any adjustments. And if you've paid too much capital gains tax, you'll be able to get that back when you submit your tax return. If you're not in self-assessment, and the only thing that you have to report is this gain, then there isn't actually any requirement for you to register for self-assessment. The property return on its own is sufficient. I think that's the end of that section. So Sam, could we move on to the next slide, please? The final thing that I want to mention to you today is making tax digital. Next slide, please. So you may recall that this was originally due to start in April 2018, and it would have applied to landlords and unincorporated businesses with annual turnover in excess of the VAT threshold, which was 85,000 then and remains 85,000. The turnover threshold was going to be reduced to £10,000 in April 2019. However, this plan was actually scrapped by HMRC, and all that happened instead was that starting in April 2019, Making Tax Digital only applied to VAT registered businesses with turnover in excess of the VAT threshold. That's actually going to be changed next April, and all VAT registered businesses, whether or not their turnover exceeds the threshold, will have to come into the Making Tax Digital regime. Next slide, please. What we know now is that Making Tax Digital for income tax will be mandated from April 2023, so that's in just 2 years' time. Unfortunately, we don't yet know exactly what's going to be in the legislation, but we do know that it will apply to landlords and unincorporated businesses with gross income in excess of £10,000. We also think that it's likely to apply to total gross income. So if you're a landlord and you've also got a business and you've got £6,000 of rents and maybe £10,000 of business turnover, you've got turnover in excess of £10,000. So you would probably fall into the MTD regime. Next slide, please. Now, there will be exemptions, and we think they're likely to be very similar to the current exemptions for Making Tax Digital for VAT. So if you're digitally excluded, so if it's just not practical for you to do online returns due to disability, age or remoteness, that you should be able to not take part. Or if there are religious grounds, if your beliefs are just not compatible with using electronic communications or keeping electronic records, there'll be an exemption for that as well. Next slide, please. So HMRC say that the advantages of digital record keeping are that software will help run the business and help you to reduce avoidable errors such as mistakes in manual calculations with adding up or transposition errors. They also say that it will reduce the risk of errors because of lost or incorrectly recorded invoices. They also say that it will make it easier for you to share your records with your agent. Now, that bit is certainly true. And another advantage will be that when you're making quarterly returns, you will have in-year figures of how the business is doing. So it'll be much easier to manage your finances and help with budgeting. And if your agent is getting sight of figures on a quarterly basis, it'll be much easier for them to offer planning based on your current figures, rather than having to wait many months after your year end, as can happen at the moment. Next slide, please. So once this starts, what are you going to have to do? You will have to keep digital records using software or apps, and you will have to submit quarterly returns of income to HMRC using Making Tax Digital compliant software. Then you'll have to submit a final declaration and make any adjustments necessary to arrive at your taxable profit. So that would include capital allowances and things like that. On the final declaration, you can also include details of other personal income and reliefs. So it's possible that this may stand in the place of your tax return, so you wouldn't have to do that as well. But that's what we think at the moment. Then you're going to have to pay your tax by the 31st of January the following year, just as you do now. One thing just to mention here is that in March there was a tax day where many accountants feared that HMRC were going to sneak out some unpleasant tax things that they hadn't put into the budget. Well, that bit didn't really happen, but they did release details of consultations, and one of the consultations is on timely payment. And what they're going to be looking at is providing options for in-year tax payment based on the tax figures from the quarterly returns. Now, obviously that's just a consultation and we don't know what the result of that is going to be, but it is possible that at some point in the future there will be a change away from paying your tax in January and July only to moving to, quarterly or maybe even monthly. That's pure speculation, but that is something that HMRC are asking for responses on at the moment. Next slide, please. So we know that Making Tax Digital for income tax is definitely happening, and I suggest that you really should start to get ready now to make life easier for yourself. Move over to keeping digital records. If you can, use a separate bank account for your rental income, because that just will make it easier when you come to doing the quarterly reports and identifying things. Definitely talk to your accountant and see what they suggest. There is a pilot available with HMRC for Making Tax Digital for income tax, and I've shown the link there on the slides. To take part in the pilot, you need compatible software, and there's also a link there for HMRC compatible software. Next slide, please. Oh, that is the end. I thought it was. Sorry about that. So I will now hand you back to Alistair to sum up. Thank you.
Okay, thank you very much, Dorothy. So Sam, if we can just move on to effectively what's my summary slide. I think from what you'll have heard from Dorothy there in terms of the compliance aspects, one of the key things to be aware of at the moment is that compliance for buy-to-let investing is increasing, whether it be the capital gains tax reporting rules or whether it be Making Tax Digital. HMRC are expecting to get more information from you and earlier, and that is something that one thing that we are seeing in terms of HMRC's enthusiasm for imposing penalties where people fail to hit a deadline, that is definitely increasing. So in the sector, just be aware that the administration is increasing and the risks of getting penalties for falling over something are also increasing. Now, you'll have seen in our webinar that in terms of the stamp duty reductions, there is a little bit of a time imperative for some transactions. You may be able to get a transaction done before the end of September and so may be able to benefit from a reduction in stamp duty. There is also, however, just a degree of, if it is buying a property that you don't currently own, just bear in mind that it might be something that come October and November that prices start to soften as the stamp duty incentive to drive transactions may start to fall away. Clearly in the budget there was a fear of capital gains tax rising, and on the subsequent tax day at the end of March there was definitely an expectation that capital gains tax was on the radar, because HMRC have been consulting, does capital gains tax need to be changed? The feared rises didn't occur, but if the consultation is ongoing, at some point it's going to come back again. And so just bear in mind that capital gains tax may come back onto the agenda at some point. The corporation tax rate increasing to 25% from 2023, that will increase tax costs for investors who have incorporated. At the same time, it also increases the rate of tax relief for buy-to-let companies on borrowing that they have, for example. So the increase in corporation tax, if we look at everything in the round, we would still take the view that if you're going to use a company to build a portfolio, so you aren't going to extract the profit or 100% of the profit as you go along, continuing to view incorporation as a good way to build a portfolio can still make sense. And with that, that will then bring our presentation to a conclusion in terms of the slides. The last slide should just be a question and answer slide. We haven't done any questions apart from one from Matt in relation to will copies of the slides be sent out, to which the answer to that is yes. Dorothy, you did have a question in advance, so if you want to just cover off the one that was submitted in advance and the answer to that.
Yes, certainly, Alistair. So the question that has been submitted was, what are the tax implications of transferring ownership of rental properties without any debt from one spouse into joint ownership? And the answer to that is that there wouldn't be any capital gains tax to pay on that transfer. That's because transfers between spouses or civil partners are treated on a no gain, no loss basis. There's no capital gains tax to pay, and instead the transferee just basically takes on the base cost of the transferor that has been sent to them. There also wouldn't be any stamp duty if there's no mortgages on the property. So your only cost of the transaction would be the solicitor's conveyance fee at that point. But then having done that, the rent is then going to be split equally between the two spouses. So each person's share will be taxed at whatever that person's marginal tax rate is. So if the idea is that you're going to shift a property from a higher rate taxpayer and split that between sort of two spouses, one of whom's only a basic rate taxpayer, then there's certainly going to be an income tax saving on that. So overall, that seems like quite a good idea.
But on that one, Dorothy, you frame it on the basis of there being no debt on the property. In terms of there being debt on the property, now I think one of the things just that people need to be mindful of is that if there's debt on the property, it can be deemed to be consideration for stamp duty purposes.
Yes.
And so spouses or transfers between spouses, you need to be careful if there is debt attached to the property, and then it can give rise to a stamp duty charge that might be unexpected if it was something that was just being done between spouses.
Yeah, so I think one of the solutions there would be that if you realise there is going to be some stamp duty, then could you do the transaction over two? Could you split it so that you're not? I mean, obviously not one bit one day and one bit the next day, but could you do it one bit and then a decent period of time and then the next bit, and then both transactions could be below the threshold? That's one option that you could do to make it a bit less.
Okay, thank you. And unless we have anything else, no. Oh, hold on. Okay, actually, so we do have one, Dorothy. So this comes back to the 30-day reporting. So what happens if a person doesn't report the capital gains tax gain under the 30-day reporting rules? within the 30 days. So effectively, you're doing a late report under the 30-day reporting rules.
If you don't do it on time, you get a penalty, which I think is £100, which will then go up if the delay extends beyond about 6 months, and you will also be charged interest. So if you sort of fix your mistake reasonably quickly, then it's not going to be too costly, because the rate of interest at the moment isn't terribly high. But if the longer it goes on, obviously the more interest will be charged and the penalties would increase.
And then I suppose one of the key things with that as well is that HMRC systems, HMRC get data from the land registry. If you want to see whether or not that exists, if you go on to the UK's land registry, you can search by any property that's in England and Wales, and you can see what date the last transaction was. If HMRC have got that data and they know who owns the property and they know it's been sold and they haven't had a capital gains tax return showing that, you can join the dots quite quickly to get to the conclusion that they will eventually work out that a return hasn't been submitted within 30 days and penalties will unfortunately follow. And HMRC's approach in terms of if something is due as a penalty, it is due. And so it is something where in terms of the 30-day reporting deadline, it will start to be something that will cost people money where they inadvertently haven't made a return, and HMRC's approach will be, unfortunately, the rules are now well known enough that they should be followed.
And it's worth pointing out that HMRC really do look at that kind of thing, because we obviously haven't seen it for 30-day reporting yet, but we do get that cropping up now and then, where we get our client gets a letter from HMRC that says, we think you sold a property last year, and we noticed that it wasn't on your tax return. So this does happen. HMRC do look at those records, and they probably will find out.
Okay, I think that covers all of the questions that we had, and so thank you very much for presenting, Dorothy, and thank you to everybody who's attended. Copies of the slides will be sent to the attendees, as will be a copy of the recording will be made available to the attendees as well. So with that, I will say thank you very much to everybody who's attended today.
Thank you.
Thank you.